Hello, everyone, and welcome to a new episode. Today, I have a very special guest, Dr. Yatin. I've been listening to his podcast for years. Beyond MD is a great podcast to grow your financial literacy as a resident. And it's very important to start early in your career, even if you're residency or in medical school. And this podcast is the way to go. Welcome, Dr. Yatin.
Hey, Roupen, thank you so much for having me today. Really happy to be here.
Oh my God, I'm so honored to have you here too. Okay, so let's start talking. Let's say I'm a medical student who just got into residency and I will start getting some paychecks. Or I'm an international medical graduate who came here and for the last several years, I've been working so hard to get into the system and I got in and now I start getting some money back. Where and how and what should I do to grow my financial literacy in addition to listening to Beyond MD podcast?
Well, first of all, it's so kind of you to mention my podcast, and I think you're asking the right questions. I would say the first thing and the most important thing is to become financially literate, and I don't mean this in a harsh way, but in medicine, when you think about our lengthy training, our day to day, what we do, everything we do is so far removed from finance, and I always kept harping that I think financial literacy should be introduced into the medical curriculum formally. But now, having been learning in this space for a couple of years, it's hard to do because we live in a digital age where there's so much medicine to learn. So I think people feel saturated enough. So I think the onus then becomes on us to learn this information. And so if I was starting fresh, if I was coming into the country or even a graduate here, I would try to focus on a few resources that I know now are tried and true. And interestingly, a lot of them are run by some of our own physicians. So, as many people know, there is an online financial community called Physician Financial Independence. This was started by Jane and Paul Healy, a husband and wife physician couple. And it's basically a private forum for doctors and their spouses and dentists and their spouses to ask any questions finance related. Now, I don't use that forum to learn all the material because there are a lot of opinions out there. And the one thing we'll talk about later is in finance, not one shoe fits all. So you have to tailor things to your own situation. But that forum is a very good starting point to see what's on other people's minds, because if it's on their minds, it's probably going to be relevant to your situation at some point. So it's a great place to introduce yourself to basic financial concepts and ask questions in a safe space. The other resources that I have enjoyed learning from myself, one is called Breaking Bad Debt. That is the handle for Dr. Stephanie Zhao, and she does a really good job in video format, because one thing I've learned over time is people enjoy watching videos, and she goes over a full gamut of topics, from things like how you get compensated in medicine, insurance policies, budgeting, spending, and then evidence-based investing. So she covers a lot of ground there, which is very good. Also, the Looney doctor, Dr. Mark Soth, who is a critical care doctor based out of Hamilton. I had the pleasure of meeting him at the Physician Empowerment Conference in June, and he has been running a wonderful blog for several years now called the looney-doctor.ca. I believe it's .ca, but you can just Google the Looney Doctor. A lot of his initial topics were quite advanced. A lot of them were tax focused, but now he's come out with a new basic finance 101 curriculum for beginners and intermediates in the space. And I think he publishes articles every Friday, and I've been reading them since he came out with this about a month ago. So that's very high yield. And also there's Physician Empowerment, who I've become friends with. That's run by Dr. Kevin Milo, Dr. Wing Lim, and Dr. Dmitry Ranev, who are all either primary care physicians or emergency physicians. And they hold webinars and they hold an annual conference. And the last one was in June in Toronto. And the last physician resource I'll mention is by Dr. Matt Pointer, who is now a newly retired emergency doctor. And he runs a blog. It's called Smart Money MD. And he writes in his blog very frequently. They're very high yield topics. And he also runs a Smart Money MD course. It's run by him for other physicians. So if I was going to start again and make myself literate, I would start probably with these resources because they are practical points. A lot of the points are relevant to doctors, and it's all done in an unbiased way. And the other one, if you want to take it one step further as well, I'll mention my podcast, Beyond MD. I started this 2 years ago, and it basically I come out with an episode every third Thursday or Friday, and I've tried to cover a lot of topics just outside investing, because I think finance encompasses many things. You have to learn about tax, you have to learn about estate planning. Many people want to learn about real estate, insurance, pension plans. So I try to cover everything. So the Beyond MD podcast is there too for anybody who is interested. So I would start with any one of those amazing resources. And then I have a few favorite books as well that I like. One was called, what was it called? It was called Winning the Loser's Game by Charles Ellis. And this is basically an evidence-based overview on common sense investing. The other books that I've benefited from, Cash Flow Quadrants by Robert Kiyosaki. And then the Couch Potato, the Canadian Couch Potato podcast is an amazing resource that is, I think, aimed more to beginners and intermediates. And it's also on common sense investing. So I think that's a good starting point, and we can pick away at things as the interview goes on.
Yeah, I would just double emphasis on the financial independent group. Like, it is a great. The nice thing, it's like you don't need to put a specific time during the day to read it. Like, whenever you're on Facebook, you're going to see a post, just someone posted something. Give like 1 minute to read it, because like literally all the situation that happens, they are just like doing a medical MCQ and finding the right answer in the comments. Literally, it's just like, I have this problem, what should I do? And you see like different inputs and different ideas, and then eventually you can come up with your same answer. And I think it's very important to start this early in anyone's training, because like that's where I grew lots of my financial literacy, and it's amazing group. I ask lots of questions there. Even like if you want to post anonymously, you can do that. So I'm like, all the other resources you gave, they're amazing. I'm familiar with most of them, so they are really valuable.
Yeah, Roupen, can I just add one thing there?
Yes.
I think it could be really hard with our jobs and our training to try and absorb some of this financial content as well. But the reason I think it is so important is, in good times, it's very easy for anybody to do well. You can just put some money aside into stocks or ETFs and things will go up. But I think it's when testing times come, like when we have now with interest rates going up and there's a lot of stress, when you have the right knowledge base, I think you'll be able to come up with a plan, and you'll have the confidence to kind of stick to your plan and ride things out. And I think that's where financial literacy becomes all the more important. And it comes in small steps. So even if you set aside maybe 1 day a week where you read an article, small steps is usually the path forward. But I think that's why it's ultimately really important.
I completely agree with that. Yes, and the resources are very valuable. They are really good. Okay, so when people get into residency, I think the first thing people like think about, or students or residents think about, is like how I'm going to survive. Some residents have even families and kids, and some international graduate or Canadian medical graduate went to Ireland and came here, or even Canadians who studied here. Like, sometimes you need to access extra money. And one of the vehicles that's very common in residency is line of credit. So do you think getting a line of credit is a good idea? What should I look for when I get a line of credit? And how should I use it? What would be like your opinion regarding this topic?
It's a very timely question. I think, practically speaking, most people who come to Canada, whether you're coming from outside or even if you're starting here, cost of living is pretty expensive. And I think most people will have to rely on a line of credit in some form, unless you have a lot of support from your family, which in that case, you're going to be very fortunate. In medical school, I'll admit I was one of the fortunate ones to get some assistance from my family. But yeah, most people will need a line of credit in residency. One thing you'll have to look at is the rate. And for most medical trainees, you should be able to get a rate that is hopefully a little bit less than the prime rate. The prime rate now is very high. It's sitting at 5.45%. So you're usually aiming for a 25 basis points, so 0.25% less than that. So today that would be 5.2%. I mean, it's much, much higher than it was in the pandemic, but that's kind of first thing you should look for. The other thing that you can inquire about is what's called a grace period. And lenders can be variable when it comes to this, but a grace period basically means every month you'll be slowly paying off the line of credit, but then they can give you a bit of a grace period to allow you more time to pay off the interest. And that can even extend 24 months after you start your staff job. It could be helpful for people to kind of manage their monthly cash flows, their ins and outs, but ultimately that interest is going to have to be paid off. So in a way, you're kind of deferring those interest payments. That's one thing you can also look into. In terms of how you should use it, Roupen, I'm a big believer that we can only spend in so many different directions. I like to create a little bit of a pie graph, and I look at what are my expenditures going to be. So housing is the biggest one. I live in the GTA. Naturally, that's very expensive. The other things I'm going to be spending money on: transportation, my car. I'm going to be spending money on food, and then other things like my kids' schooling, potentially clothing and travel. And in that pie chart, I really have to pick and choose what is of greatest value to me. I value my kids' education. I value my home. I value travel. Those are probably my three biggest things. So I have to save money in other ways. So I think this starts early when you're a trainee, when you're an early physician. You kind of have to figure out what are your core values in life, what's important to you, and really spend money in those quadrants. If you start spending money in every single area of that pie chart, with today's cost of living, good chances that things will catch up to you, and you're going to be starting behind rather than forward. You don't want to take steps back financially. So I would be mindful of that. I think that's probably the single most important point on this topic that I can communicate. And the other thing that comes up is, should I use my line of credit to invest? It was very easy to say in the earlier days of the pandemic when the interest rates were rock bottom that yes, it makes some sense, because even if you generate a 6 to 7% return, the interest rates were very, very low, and inflation was much more normal back then. But now you look at interest rates being, let's say, prime rate minus 0.25, you're looking at 5.2%. You're looking at inflation, which is over 5%. Even if you generate a return of 6%, your real return is negative. So by investing that line of credit, what are you truly accomplishing? We'll talk about this a bit more later, but I think the one good thing by investing early is you can set up good habits. But I'm not of the mindset that you should be taking your line of credit and using that as leverage to invest. It's a very, very risky proposition, especially today. So that's my take on the line of credit.
I completely agree with you. Only one question. So when I started residency, I didn't know what is a prime rate. I know now. So if you're going to define prime rate in very simple English language, what would you say?
Yeah, well, the prime rate is basically the rate that major institutions are going to, lend at to the average borrower, and so that's dictated by the overnight rate. The overnight rate is basically set by our central bank, the Bank of Canada, and that is essentially at 3.25% now. So the prime rate right now is 2.2% higher than the overnight rate. So it basically follows the overnight rate, which is what rate the central bank sets. And that's kind of the average rate, let's say, for the average borrower with a decent credit score. That's how I like to think about it. And as medical trainees, as physicians who are going to have hopefully secure jobs and some level of financial security, most lenders may be willing to give you maybe some cut, some discount on that prime rate.
I just want to also add one point, one of my mistakes when I did
see.
So I got in residency. I went to one of the big banks. I said, I want line of credit. And they said, okay, so we can give you 15,000. And the rate was 9%. And I took that. I started spending from it. And I at that time, the prime rate was 2.25. And I had no idea. So I kept spending from this. I'm thinking that I got a good deal because the regular credit is 24% if you're going to use your credit card, and this is 9%. I was amazing, until one day one of my friends come and we were talking about this topic, and he says he's prime minus 2.25. I was what is this prime? What is? And then I figured out that I was getting overcharged by 6%. So that's why I highly, even if you go to the big banks and you said you're a physician, if you're not being served by a person who knows to serve physician and give them the right products for them, you might get high. 9% still high. And it's
happened to me. It's happened to me as well early in the journey. And the only other thing I will encourage people to learn about is learn about interest rate cycles. Learn about, how high do the banks tend to raise interest rates? How long did they plateau for? And how long is it before rates start to come down? This can help you kind of ride out difficult periods when you're trying to decide, for example, if I'm buying a home, do I go fixed? Do I go variable? Although I will say the current landscape is unlike anything that most of us have seen, but having an understanding of these interest rate cycles can be really, really helpful. in allowing us to navigate these decisions.
I completely agree with that. Okay. So one of the other things that I read a lot on Facebook or other groups is like get a life insurance or get disability insurance, get it early in your training because it's going to be cheaper. Once you're a staff, you're going to be paid more. So there is a lot of emphasis. Many banks will come and give you that product. So that's one. And the other thing, if you go and talk to the average Canadian, the average Canadian will never get like disability insurance or life insurance. It's heavily marketed toward physicians and professionals. So first, why should I get life or disability insurance? When should I get this? Should I bother to get them early? And what are the benefits?
Very important question. So let's start with disability insurance because that is most likely it's the most important type of insurance that we're going to get. So disability insurance is essentially it's insurance that will protect your income. And as a physician, as a healthcare worker, thinking about all the time that you put in to get to where you are today, your greatest asset is your ability to work and generate income, and you need to protect that. So when should one start with a disability insurance policy? It's hard to convince somebody in medical school to start it because they don't have an income. And so then they'd be borrowing money through a line of credit to put into a disability insurance policy. I think it's much more reasonable to consider starting in residency when you do have an income. And the truth is, when you're younger, when you're a resident compared to staff, the rates will be lower. So the premiums that you're paying every month to the policy will likely be cheaper when you're a resident compared to when you're staff. So it's reasonable to start this in your residency. Now, that being said, I didn't start until my first year of staff. So I was a little bit delayed there. So disability, essential for everybody. It doesn't matter if you have dependents or not. It's to protect your income. And you can decide on how much of a premium you want to pay. That will dictate what kind of benefit you get should you get disabled. So usually what happens is, God forbid, if you get a disability, there's usually a period of 90 days. And then after that, you'll get the payout. And how much benefit you need, how much payout you need, really, to me, it depends on what your lifestyle is. You want to cover all your basic expenses, the house, the mortgage, the cars, depends on maybe the kids' education, and then maybe give yourself a little bit of a buffer beyond that. So it's an individual decision there. Now, when you're signing up for a policy, I didn't know this when I was signing up, but there are a few riders that you want to look at. So a rider is basically an option. So the three options, I'll just comment on this. One is the cost of living adjustment. And this cost of living adjustment, it basically applies when you have a long-term disability of at least 12 months. And when you're getting paid that benefit, the cost of living adjustment will ensure that that benefit that you're getting paid each month will keep up with inflation. The other rider that you want to consider is a future income rider. So for example, if you sign up for a policy when you are a resident, the future income rider will allow you to sign up for more coverage when your income goes up. So let's say you're earning $65,000 as a resident, and let's say the benefit that you're entitled to through your disability insurance policy is maybe $4,000 or $5,000. Well, when you're staff and let's say you're earning $400,000, your cost of living will probably go up. You want to protect more of your income as well. And so it allows you to sign up for more coverage without having to really prove your health. So that's the future income rider. And then there's also the third rider called the own occupation rider. Typically something that specialists will consider, but essentially it can tailor the policy to your needs. And essentially, if you get disabled, the own occupation rider can allow you to still have a benefit paid out if you're disabled. But in the meantime, you can still maybe pursue other work, whether that is a home business that you've created on the internet, whether you decide to go into real estate and become a realtor. So that's where the own occupation rider can come in. Those are the three things that I would consider, but disability insurance, the most important. I can dive into life insurance a little bit, or if you had questions, Roupen, on disability, I can address those now too, or do you want me to go straight into life?
Yeah. If let's cover the basics, like, because if you want to go, like, there are great episodes on the insurance beyond MD.
Yeah, I have to do some more too. But life insurance, okay. If you have any kind of dependent, for most of us, that's going to be children. Some people, though, are supporting elderly parents or somebody who may in the family who may need help. If you have dependents, you need life insurance. If you don't have any dependents, I don't think you need life insurance. For most physicians, I think the most useful type, especially when you're starting off, is term life insurance. So that's basically where you're paying a set monthly amount, and you're going to be basically covering yourself with a policy for a certain term. That could be a 10-year term, that could be a 20-year term. For example, I have a 20-year term policy. So I'm 38 right now, and I actually just topped mine up. But basically, my life insurance policy will cover me until age 58. And at that point, I basically decide, do I have enough to self-insure, or do I still need more term life insurance? Now, the other type of life insurance is called permanent life insurance. And the two types of permanent life insurance are whole life insurance, and the other one is universal life insurance. For most physicians starting out, you probably don't need to look at these things at all. That is my view. Now, I think in the physician community in general, I think these permanent life insurance policies are quite frowned upon. And that's fine, but I think they do have a role and a place, depending on your situation. But the way I like to think about these policies is, if I'm enrolling in one, the main purpose of it is for estate planning. And that is basically to have money in the policy set aside for the next generation. It's not really going to be my go-to for retirement. That's kind of how I like to think about it. So I'm not there yet. I don't even know if I will ever consider one. But that's basically disability and life. And the only other thing I will say is disability insurance, because you want the benefits, if you're disabled, to come to yourself personally, tax-free. You should be paying for disability insurance personally, not through your corporation. And life insurance, on the other hand, you can pay for those premiums from your corporation.
Okay. I'm just going to add something there. When we mentioned corporation, it's a term that is not very familiar to lots of trainees, especially in the early during their. I think we should get more knowledge about when to incorporate and how to incorporate. I think there's also another episode in Beyond MD about corporation. I think it's a term very important to just get familiar with. Because it does have its own benefit. And when people think about corporation, so they think only that you can incorporate when you become a staff. Actually, like, you can even incorporate. I think earlier, if you have like a small business, or you can do like some work from home. For example, I do some work from home. I have a site. So I already like have a small corporation. So it doesn't need to be that big thing, but you have to be familiar with this, because like getting those small bits of information and figuring out problems as you go earlier in training, that will help prevent big mistakes when you become our staff. We have more responsibility and less time. Okay, awesome. And so we talked about the disability and life insurance. And now when people get into residency, like they start like getting married and settle down, buying a place where you can call home is a dream for everyone. Some people prefer to rent and some people prefer to buy. And some people have the mentality that your home is your biggest investment. Okay, so should I buy a residency or not? And how should I approach this? Like, what are the things that I have to, what is a checklist, mind checklist that I have to go through when I ask myself the question, should I buy a place or should I rent?
Yeah. This is a very good question. So I think I've made mistakes here, and I could shed light on my past. But when you are a trainee, my view is that for many trainees, many residents, your life can be in flux. There could be a lot of variability in your life. You don't necessarily know, well, will you be doing a fellowship? Where are you going to end up with that fellowship? And at least when I was applying to radiology, Roupen, the job market was really tight in Ontario. As much as I wanted to come back to Ontario, I didn't get a job in Ontario. And I ended up in Alberta. I worked in Calgary for a year, had a wonderful time there. But the point is, there's so much uncertainty when you're a resident. And who knows if you're married to another physician, if your spouse is a physician, where are they going to end up? When you have a dual physician household, things can become even more complicated. So when things are variable, when you don't have certainty and you don't really know physically where you're going to be, my inclination is at that point, buying real estate, buying a home, it can hurt you if you're forced to make quick transactions. So if you're forced to buy and then you're forced to sell in a quick amount of time. This happened to us when we were in Calgary. We caught the bug, saw the first paycheck, and after a few months of renting, granted, we were expecting our second child at the time, we decided to buy a home, ditch our rental, and we bought. And then literally 3 months after we bought, I was interviewed by a hospital in Toronto and then given a job offer. So we bought and sold in 8 months. Like, we could have been hit really hard financially. Fortunately for us,
Oh,
there weren't any land transfer taxes at that time. I don't know if there are in Alberta now.
yeah.
Yeah, and then the second mistake we made was amidst all that uncertainty, we decided to go for a fixed mortgage rate. When you have a fixed mortgage rate, you have to break that mortgage. You have to pay heftier penalties. We paid an $8,000 penalty at the time, and whereas if you were variable, you would pay 3 months of interest to break your mortgage. So my gut is when you are a resident, I know that many Canadians, many people aspire to own a home. Owning a home can give you that stability and happiness. I don't necessarily think it's the best idea in residency. Once you know that you're going to be somewhere for a longer period of time, in my opinion, that's when it's more worthwhile to buy a home. And I can tell you, I don't want to go into the weeds here, but our decision to buy and sell a home in Calgary had financial consequences. Like if I had not done that, if I had kept life simple, if I had rented, and if I had instead taken that money that I put into the down payment and I had invested it into the market, I would have been $100,000 ahead today, further ahead than I am now. It's not life or death. It's not necessarily make or break, but it had consequences. So first thing you have to ask yourself is, what's my situation? Am I stable? Am I going to have to move? If the answer to all of those things is no, then I would say maybe reconsider buying a home, maybe rent, even though rents are really high right now, because real estate can get expensive if you're transacting frequently. And then when you decide to buy a home, depending on your situation, then you will decide, do I go variable? Do I go fixed? If you're a trainee and you really decide to buy a home, I would say to give yourself the flexibility, I would go on a variable rate mortgage if I could do it again, because the cost to break that mortgage is much less when you're on a variable. 3 months of interest as opposed to a very opaque and convoluted interest rate differential calculation with a fixed mortgage. And in my life, I'll be honest, I've broken 2 fixed rate mortgages and it's amounted to $40,000 in fees. So I'm variable all the way based on my experience. So yeah. But
Okay.
again, that's not advice. This is just food for thought. So
Yeah, exactly. I was just going to add my experience as well. So like I bought a
yeah,
house.
please.
It wasn't mine. Like, so my parents are in town and I bought something that they can stay here. So I got it during COVID and I got a fixed, but I knew that my parents will not, or I will not move them outside of Ottawa. They stay
Yeah.
in Ottawa,
Yeah.
to whatever I want. So I got it fixed and it works very well because like when I got it, it was like 1 point something and now the interest rates are crazy. So there is always like no right or wrong answer, but my situation is
Yeah.
it wasn't mine, it was for my parents, and I knew they will stay there. So again, it's a very case dependent, and that's why I'm doing this. People like they study their case, and that's the nice thing about the Facebook group, the Physician Financial Independence. Because like someone's case might apply to you, and you might learn from
Yeah.
someone's mistake. And buying a house, I would only add one more thing. When I initially was in the process, I was like, okay, I'm paying for rent, for example, or my parents are paying for rent 1,500. Now I'm going to pay mortgage 2,000, for example. I was like, oh, that's much more cheaper. But then I got surprises by the tax, which is like 350, 400 bucks a month, by the insurance, which is much more if you own a house than renting, by the other utilities that I didn't pay for when we were renting. So all these expenses.
Oh my God. You are talking about so many important things, Roupen. So while we're at that, so insurance to own a home, you have property taxes,
Yes.
you have the utilities. If you're renting, maybe you're not paying those utilities. You are paying for all the maintenance fees, damages, and then basically mortgage interest, and then land transfer tax, right? If you buy a place, most places in Canada, you're going to have a land transfer tax. So just have to remember all those extra costs as well. Although for most people, I think if you bought a home before the pandemic, yeah, you've probably generated some wealth. But again, that's it's important to be thorough and take into account all the costs.
Exactly. Okay. So most of the people who comment in the Physician Financial Group, they are like staff and they are making money. And we usually think about investing in the stock market when we get into that stage of life, beyond the training. But I'm a believer that we should start early. So that's why I want to ask you this question. Should I invest in my residency? And what are the things I should target? And how much should I invest? What's your idea? What's your opinion about this topic, investing in residency or medical school?
Yeah. As for should you invest, in an ideal world, yes. But let's just take a look at one end of the spectrum. If you are burning through most of your savings, and at the end of the day, you don't have much disposable income left to invest, and then that's forcing you to pull out of a line of credit, as we were talking about, the interest rate on that line of credit right now is very high. You add on inflation, and if you're only going to generate a 6% return, let's say that's an average return for the next 5 years, I'm just not sure how much you're accomplishing there. So, in my view, today, as much as I want to invest early, if I was a resident and get into the market earlier, allow that time to work for me, I'm somewhat debt averse. And I feel like if you work hard at practicing good day to day habits, controlling your expenditures, and paying off your debt early, I think there's a strong argument to be made for that. Now, that being said, if you're able to control your spending and you do have money left over at the end of the month, I think it's a great idea to start investing. You can't time anything. The best day to start is today. So even if that means, Roupen, investing $50 a month, $100 a month, I think by doing that early, you're setting yourself up for success because you're putting into play good habits early. You're basically making that commitment to yourself and getting on a regular schedule. So that's kind of my take on whether one should or should not invest. Ideally, yes. Now, in terms of how to invest, I think when we start, I know I've been investing for a little over 4 years. I'm still new in this space. So I got that late start. I started investing at age 34. But, anyways, I used to pick stocks. I used to try and analyze companies. And then with time, I think the most important thing I've learned in life is where is my time best put to use? You know, my time is best put to use practicing medicine, generating income through that, spending time with my wife and my boys, and creating memories with my loved ones. My time, I've decided, is not best spent dissecting through financial reports and trying to predict if a company is going to go up or down. That's just my view. So now when I invest, most of the buying that I do is actually a single ETF that invests in a global basket of stocks because I don't think, even if I put in more time, I don't think I could beat the returns on that. Now, I am diversifying. I am interested in real estate. I view that as a good seed to plant if you have the means to do so.
Yes.
But that, I think that planting that kind of seed does take some time, and it's certainly not anything that I started when I was a resident. So that's my view. I think one of the most important lessons is figure out what your values are in life, figure out where your time is best put to use, and I think that will allow you to make the best decisions for yourself and your family.
I completely agree with that. I think you mentioned one of the most important things. It's the value of time. Like literally, it's something that I learned through residency. Like we have all limited amount of time, and where you spend it, it's very important. And those are the things that will matter at the end of life. I'm just gonna add my experience there. Like what I did in residency,
Yeah.
I didn't invest a lot. I had like some extra money during COVID. I had nowhere to go or nothing to spend on. So whatever I had, I just was reading through the Precision Financial group, and I was like, okay, so some people buy stocks, some people buy ETFs, and there are calculators on the Vanguard website where you can go and figure out which works best for you, stocks or ETFs. Again, you can get familiar with all these terms through the Facebook groups and other resources mentioned earlier. So what I did is I took that lump sum of money and I just bought some ETFs and stocks, and I did not do anything else. I just watched them through the last 3 years, how they go up and down, because you have to learn that if you put for example 12,000 and in 2 months they are 10,000, we should not panic. You should there are different ideas, but just watching how they grow and how the stock market change day by day will give you a different perspective when you apply the same principle to a more lump sum 50,000 or 100,000. So knowing what happens to the 1,000 will make it much more easier to know what to do with the 100,000 or the 1 million.
Absolutely. Roupen, I'll add a couple of points there. I mean, I'm really glad you shared your story, and I can tell you, you're PGY4, I believe, right?
Yes.
You're PGY4. Yeah, you're way ahead of where I was at PGY4. Like I could just tell you're very level-headed. You're a very curious learner, and you have much more knowledge than I did when I was PGY4. So good on you. And I think you're putting in the effort to learn all the right things. Now, watching things go up and down, I think it could be a double-edged sword. You're the type of person, I think you're learning a lot from that, and you're understanding that there is volatility in the short term. That's par for the course. But I think it sounds like you're training yourself to understand that this is the norm. This is how things are going to be. It's
Yeah.
not going to sway me from my path. Somebody else, though, if they're checking their portfolio on a day-to-day basis, that can sometimes lead to emotional reactions. And when we're thinking emotionally, like this has happened to me. It's amazing. When we lose money, we react to that in a more intense fashion than when we gain money. You know, the thrill of gaining money. I
Yes.
remember I invested in this one company, and I wish I invested more. It was a small amount. It went up 70% overnight because somebody made a
Wow.
bid to buy the company at a certain share price. And I got so excited. I sold everything the next day, even though I shouldn't have. but you know what? The joy of that moment was very short-lived. And most people, not most, but many people, when they check things and they see declines on a day-to-day basis, they can get really, it's natural human emotion.
Yes,
It's
I
it's
agree with
a
that.
human nature to get emotional
Yeah.
about that. And basically the negatives of losing can be more powerful than the joys of winning sometimes. So for people to just be mindful of that, you don't want to make decisions in an
Yes.
emotional state. Yeah.
And exactly that point I didn't. So when I did that, I already had the knowledge that you buy, you hold, you do nothing. And I said,
Yeah.
like, okay, so I'm going to just watch and wait. Again, there are different ways, but I think that's a very good point to bring out here. Okay, these are my main questions. Like, any last tips? What would you say to your younger self when we were PGY1 starting residency now?
Yeah. I mean, I think back to excuse me, my past and how I've lived this journey. I can tell you that my younger self was somebody who was very much somebody who was all tunnel vision. I went to undergrad. I wanted to get into medicine. I badly wanted to get into radiology in my last few years of medical school. Then it became about the fellowship. And I feel like, Roupen, if I just took a break, just tried to learn as much in my day to day and tried to focus on relationships, curiosity, treating each and every day as a way to learn, not just about medicine, but about other things in life. You know, I think my younger self could have had a more diverse experience and more diverse upbringing. So I think, for example, what you're doing here, you're learning outside your domain on a day-to-day basis. I think that's wonderful. That's one thing I would have told my younger self, and I would tell trainees to treat each and every day as an opportunity to learn about as much as you can. You know, you have one life to live, and I think if you approach life in that way, I think you'll be thankful for it, and frankly, I think you'll enjoy life a lot more. And then I know I keep coming back to this concept, but figure out what resonates with you, what your core values are in life, and just follow that path. And I think that will lead to a fulfilling life, one that has many meaningful relationships and also financial security. So I'll leave it at that.
Amazing, amazing. Yeah, I completely agree with that. I think we get so overwhelmed by medicine, we stop looking outside of the box. And to enjoy medicine, you have to do something outside of medicine. You have to teach people something because, like, there are
For
many.
sure. For sure. Yeah.
Exactly. I completely agree with that. Thank you so much. Thank you. This was an amazing. I think we covered very basic stuff. To get more knowledge on the topics that we talked about, Beyond MD, it's a great podcast, and you're going to go earlier in the show. Dr. Eti mentioned many very important resources. Listen to them and read them. Thank you so much for this. I really appreciate your time.
Roupen, thank you. That's so kind of you to talk about me and my podcast in that light, but it's a pleasure to help out. Thank you for inviting me, and keep up the great work that you are doing for your colleagues as well. Okay.
Thank you so much. Appreciate it.
Okay. Take care.